What's up, guys? Welcome back to the Everyday Money Guy. I'm Mike. If this is your first time here, subscribe to the channel to increase your wealth, increase your success, put you on the road to financial freedom. While you're at it, also hit the like button. That really helps this channel and this video work within the YouTube algorithm. Today, we're going to talk about tax brackets. And when I talk about tax brackets and the progressive tax system, I'm talking about here in the United States where I and this channel are based. So if you are not from the United States or paying United States taxes, this may not apply to you. However, most countries out there have a progressive tax system of some sort. So even though the specifics might not apply to you, it'll probably still have a relatively, 30,000 foot look at it. So here in the US, we have a tax range from 10 to 37% for ordinary income. And that's going to include your wages, salaries, bonuses, short-term capital gains, basically anything that you make within 1 year that is taxable. And the way that it works is you get taxed more if you make more. And it doesn't really matter if you feel like that's fair or unfair. That's just the way that the system is right now and has been for a long time and probably will be for the foreseeable future, because I just don't see that changing. So the tax brackets are broken out into, you could call them tranches or just segments of your income, depending on where your income lands. And for 2020, for tax bills due April 15th, 2021, there are 7 tax rates that are 10, 12, 22, 24, 32, 35, and 37%. And those all have different income levels attached to them, being if you're single, head of household, married filed jointly, and married filing separately. And so, again, all those have a threshold of income that they start and end at. So one of the common misconceptions with the progressive tax system is that if you make $1 or 1 cent over the end threshold of a particular tax bracket, that you are going to push yourself into the next tax bracket and all of your income will be taxed at that next level. And you hear that a lot with people saying, well, I can't get another bonus because it'll put me in another tax bracket, or work overtime because it could put me in another tax bracket. And while they are technically correct, the idea that they have about it is not necessarily correct. Because you see, if you go up into the next tax bracket, it does not automatically mean that every dollar that you made from January to whenever you are will now be taxed at that higher rate. You see, what it does is, in the progressive tax system, the different portions of your income are taxed at different rates. So for example, on my computer here, I'm looking, if you're married filing jointly, which is what I do, and I think a lot of folks out there who will be concerned with taxes married file jointly, $0 to $19,750 is taxed at 10%. The next rate up is 12%, and that goes from $19,751 to $80,250. So if you only make $19,750 and 1 year you make $19,751, everything is not now taxed at 12%. Just that $1 that you made at that $19,750 first dollar will be taxed at 12%. And it's the same for every other step on this ladder. So for example, the next bump up is 22%, and that starts at $80,251. So let's say that the two of you combined, or just you combined if you're a single income family with like a stay-at-home mom or something like that. Let's say you make $100,000. So you are $19,750 over the bottom threshold of the 22% tax rate. You will only be taxed 22% on that $19,750. So you'll be taxed 10% for your first 19,750, you'll be taxed 12% for 19,751 to 80,250, and then you'll be taxed at 22% for 80,251 to 100,000. And it works that way all the way up the system until you get to $622,051 or more. Anything that or above will be taxed at 37%. And again, this is for ordinary income. Does not include long-term capital gains, which are taxed at in a completely different system, which I'll get into those in another video. So various things throughout the year that you pay for can be considered tax deductible and reduce your taxable income. Like I said, again, I'll do a different video on that entirely, but for the most part, most tax filers in the United States now use the standard deduction because it was recently, and I can't remember when it was, I believe it was during the Trump administration, I think around 2018, it was increased dramatically, and now the standard deduction for the 2020 tax year is $24,800. And so if you take the standard deduction, that takes that amount directly off of your income to get your taxable income. So for example, that we just used the $100,000 example, if you take the standard deduction of $24,800 for a married couple filing jointly, that would reduce your taxable income to $75,200 off the top of my head, which would then drop you into the 12% rate, which is 10% difference from 22 to 12. And so that would greatly reduce the total tax bill that you pay. So long story short on deductions is they reduce your taxable income and can drop you into a lower tax bracket. Guys, I hope this clears up some common misconceptions about the progressive tax system, where if you do end up with an income level that puts you into another tax bracket that's obviously higher than the one under it, it does not mean that your entire income is going to be taxed at that higher rate, and it will only be the dollars above an income threshold. So the next time you hear that around the water cooler, you can be like, that's not necessarily correct. People probably won't listen to you, but you're in the know, and that's awesome. So if you guys enjoyed this video, if it was entertaining or you found some education from it, please hit the subscribe button, hit the like button for me. It really helps out this channel, and I hope you guys stick around and see me next time.